I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org. My guest today is Lori Heinel, and Lori is Executive Vice President and Global Chief Investment Officer at State Street Global Advisors. Lori oversees SSGA's investment capabilities from index funds and exchange-traded funds to active multi-asset class solutions and alternative investments, leading a team of more than 600 professionals globally. Before joining State Street Global Advisors, Lori was the Chief Investment Strategist and Head of Investment Products for Oppenheimer Funds. So Lori, thank you so much for joining me today.
It's great to be here. Thanks for having me.
So let's just jump into one of the topics that there's been a lot of discussion about recently, which is corporate purpose. And many companies have been thinking about, what is their purpose? Why is the world a better place? Because they're on it. But there's been less discussion of this in the investment community or the asset management community. But I know you've thought a bit about this. Can you talk a little bit about what you see as SSGA's purpose and maybe, how that's changed over the last, few years?
Absolutely. So this is a topic that's very near and dear to our hearts. And going back several years ago now, we set about putting up a mission statement. And what we wanted was something that was authentic to us as an asset manager, but that also reflected the clients and communities that we serve and the emerging needs that we saw in the asset management community. And so where we landed was this statement, which endures today, which is this idea of investing responsibly to enable economic prosperity and social progress. And when we came up with that phrase, we were very deliberate in our choice of each word. At the time, we were already very involved in ESG-related topics, primarily through our stewardship and engagement activities. And we also felt that we wanted to represent capabilities that had a certain amount of durability for our clients, that weren't just things that were passing fancies, if you will. So this investing responsibly was derived from marrying some of those kinds of concepts. And then clearly, as a fiduciary and as an asset manager, our goal is to help ensure economic prosperity, getting our clients to where they need to be from a investment goal setting standpoint. But this notion of social progress was also something that we thought long and hard about, because increasingly we were seeing the intersection between company behavior that could engender good outcomes from an investment standpoint, but also support the communities and other stakeholders that they serve. So I would say we've been on this journey for a bit now, but it was something that we took to heart several years ago as we thought about what our mission should be.
And then how does that filter into what you do every day? So when you think about making an investment decision or taking that from that people refer to in a meeting, is that something that, when you're trying to choose which way to go?
Absolutely. I think it's a really important kind of touchstone from a variety of dimensions. And again, I think reflecting some of the conversations that we've been having over the years. So the first one is that this whole area, which we affectionately call ESG, or environmental social governance, does kind of permeate the ethos of what we do. Now, that doesn't mean that we're in business to drive just the economic or the ESG outcome, but it's really, how do you assimilate the information that ESG topics can give you to round out all of the other information you have that's more traditional financially based and make good judgments. So I think first and foremost, as an investment organization, we believe it's important to get our hands on as much information as we could possibly get. A lot of this ESG related information is now very available. It's data that you can kind of rely on, you can assimilate. So we went through a process of, really fully integrating that into our investment capabilities in a big way. But I would say it also dovetails to how we think about our business engagement with clients, because not all clients are at the same place in terms of how they're wanting to express their ESG intentionality. So, oftentimes we talk about clients in Europe, for example, as being a little further ahead of the curve on issues related to climate or related to other ESG related types of considerations. And there might be clients in other parts of the world where they're at a different place in terms of how they might approach this space. So this idea of economic prosperity is at the heart of everything we do. Like we're always fiduciaries, we're always trying to drive the investment related outcomes, but we also have to be respectful of our clients' journeys as well. So I think it becomes a touchstone for how we help engage with them and lead them, but also how we respect them.
Yeah, that makes a lot of sense. And do you think more broadly that the purpose would you apply that purpose of the asset management industry broadly, which is enabling economic prosperity and social progress, or investing responsibly? Do you think many of the other organizations have thought about that, or how do you think about it as an industry as a whole, where investors are often looking for alpha, where they which is a zero-sum game. You pick up at the expense of somebody else. How do we apply this concept to the asset management industry as a whole?
Yeah, so I think the asset management industry as a whole does embrace our role as stewards and as being fiduciary. So even though some may not have a true kind of fiduciary relationship with clients, these are typically assets that we invest on behalf of others, right? It's rarely that we're the actual principal. We're more the agency, right? We're the agent for that investment. So I think as an industry, at least most of the people that I've been involved with throughout my career, no matter what type of firm you're in, you kind of anchor on that concept, right? We're investing these assets on behalf of others. So that fiduciary kind of mindset. And what that really means is that all of us, I think, have to be first and foremost focused on what they often refer to as the pecuniary interests, right? Or the financial types of interests. I think what is becoming more apparent to many of us in the industry, at least, is that how you assess a future opportunity is much more multidimensional than perhaps we had all appreciated. And maybe it's not, but let me just share with you a concept that I've been playing around with for many years. And it's this idea that classically in investing, we think about risk and reward as being the two axes, right? So we talk about the efficient frontier. We talk about how we want to use diversification to get more risk per unit, or more return per unit of risk, et cetera. And years ago, I came up with this idea that really things related to environmental social governance are in some sense a third dimension, but their dimension is about risk and reward on the impact side, right? Are you actually creating the world you want to live in, whether that's focused on climate related issues or social issues or governance or other kinds of things. But what most investors continue to have as the primary, and most asset management actors have as the primary, is the risk reward. But I think increasingly what we're starting to realize is that there are tangible financial dimensions to this kind of third dimension. And I don't have to go very far to talk about climate as the great example, right? So we know that a company's physical footprint may be influenced by climate-related weather changes. We know that there are implications for obsolescence of certain assets that certain companies have. We know that there are regulatory things that might shift in the horizon that might change the economics of a particular business line. We know that there are supply chain issues, workforce issues. Like I could go on and on and on and on. So to me, what's kind of interesting about how the industry continues to evolve is a deeper appreciation and understanding of how these things that classically we may have thought of as qualitative, nice to have, orthogonal to the investment decision making are actually becoming intrinsic, embedded, integrated.
Yeah, I think that that sort of three-dimensional way of thinking about this is so interesting. We've thought a little bit about risk, return, and responsibilities as those three, and that if a portfolio is inefficient, in other words, if it's sort of within that, you could pick up either return or lower your risk or increase your responsibility by thinking about that third dimension, as you put it. Now, obviously, if it's perfectly efficient, maybe you've got some trade-offs to be made, but not that many portfolios are probably perfectly efficient on that dimension as of yet. So that exactly how we met, we know pretty well how to measure the risk and return axes. Exactly how to measure that third one is a bit more challenging, but is an area that I know you all have been thinking about and a lot of work has gone into as well. So.
No, I think you're spot on. And increasingly, there's more and more data that's available out there to help you at least create frameworks for measuring some of those impacts, right? So whether it's data that relates to the kind of physical world, right, that we can start to look at and say, okay, when I assess my portfolio through the lens of carbon emissions, I've got metrics, rubrics now that I can use to say, okay, portfolio A has this quantum, portfolio B has that quantum. So more and more, there's data that's available that you can actually lean into to assess whether you're achieving that outcome. I think what's still a bit more early days is the trade-off between how that part of the curve, the utility function, interfaces with the traditional part of the utility function, right? And I know we've done some work and others have probably done some work as well to say, okay, per unit of carbon reduction, how much extra tracking error do I have to take on in my portfolio? Or per unit of carbon reduction, do I think there's a return give up or return, advantage that I'm going to get? And some people have made the argument that there's actually alpha to be had when you start to integrate some of these ESG issues, because the market doesn't necessarily fully discount the value of those things into the future. But we're still early days in the tangible types of analyses that we can do and the data that we can all align on to know whether we're making those trade-offs as efficiently, to use a word, as we have done in the traditional sense.
Yeah, no, that's really helpful. And that's a good segue to a discussion about this, the disclosure climate that we are in, which is, there have been a lot of movements towards creating either climate disclosures or other sorts of non-traditional ESG disclosures. And it feels like there's a lot of momentum there. Obviously, the SEC has just issued some preliminary thoughts on climate disclosures. The ISSB is being informed. So as a global investor, there are all of these different things out there. How do you think about kind of capturing that information and using it as an investor? And then, I don't know if you think about it as much from the corporate space, but you're also a public company. So you've kind of got to go both ways here. So how are you thinking about this evolving non-traditional disclosure space?
Yeah, and first of all, I would say, yes, we're on both sides of that, but also as an asset management firm, the expectations for disclosure on our products is being strengthened as well. So there's that dimension that we're all considering. And I guess the first thing I would say is that we are fans of disclosure. So we've been advocating for many years that there needed to be more disclosure around some of these areas, because it just provides everybody with, transparency, information about things that we do think are actually impactful in terms of the trajectory of those companies and ultimately the risk return. So we're definitely fans. I think what we would also love to see is some sort of kind of globally consistent standards, because one of the hardest things to do is to navigate multiple jurisdictions where the types of disclosures or the frequency or the integrity or whatever is different, right? Because then you just have a lot more difficulty having something that's consistent, comparable across that you can actually apply. Obviously, as you noted, the SEC is in the process of working through disclosure requirements that they might require. And we are in a, going to comment on that and provide our views that we definitely think that those are things that should be considered. I think we would also argue that you don't want to let great get into the way of the good. And sometimes when you're assessing these kinds of things, it's easy to get very enthusiastic about how far we want to go with disclosure. So we would say, lean into a few baby steps or early steps first, and then let that progress through time. So there are some things that we might be more judicious around on the disclosure front, but make no mistake. I mean, it's definitely something that is necessary. It gives investors transparency. It's better if it's something that can be applied across geographies, across asset classes, ideally across industries, company types, et cetera. And then it's really being thoughtful. And you mentioned ISSB, and it's really being thoughtful about, like, what are those things that are relevant, right? So there's the materiality or the relevancy element here too, because if you ask a financial services company to provide disclosures on how they're using, animals and testing their products, right? That's not relevant. That's very relevant perhaps to a consumer goods type of a company. So you could end up having industry spend lots of time and energy on things that are just not really important to them. So transparency, consistency, relevancy.
Yeah, and I think that industry specific point is so important. And your example is a great one, which is those sorts of issues, animal issues, for example, are extremely important in some places and make no difference to others. So I'm hopeful that the ISSB, building on the history of SASB, really takes those industry standards to heart, because I know as an investor, the way most people think about companies is they're not comparing apples and oranges. They're comparing the companies more or less in the same industry with one another. So I think that's something that I hope doesn't get lost in this consolidation process.
No, I agree. And we would advocate as well in that regard. I think the other thing that is a very delicate balance is, where do you cross the line from an issue that is actually material to long-term investment performance and something that might be more, let's call it political? And I don't mean that to politicize the conversation, but there are things that investors like or don't like about all kinds of things in the world. And some of those things are more germane to an investment outcome versus others. Or some of those may be just preferences that people have around the things that they personally care about. So oftentimes when I'm dealing with clients, they'll have multiple stakeholders. And some of those stakeholders will be very focused on issues like climate, where there seems to be at least agreement that there's impact there on the investment case or the investment outcome. But then you might have other issues that are more, let's call it social issues, where there isn't really a thread between that particular investment issue, or that particular social issue rather, and an investment outcome. And I think that's the other thing that this industry needs to kind of grapple with, is there could be things that are important to people, but they don't necessarily rise to the level of being important as an investment choice.
Right. So what's your job? Is your job to worry about things that are going to affect the investment return over time? Is it to also think more broadly? And to your point on politics, what are other people's jobs? What are the politicians' jobs? What are the legislature's jobs? What are the so I think sometimes those things blur in this porous media world that we have. But knowing what your job is, that's got to be something that you emphasize a lot.
Well, they do blur, and we've seen great examples of companies getting in the crosshairs of political agendas over the last few weeks even. And one could argue that everything ultimately becomes an investment implication, because the thing called reputational risk, right? That if you're a company and you get caught on a side of an issue that's not popular, you can actually lose clients, right? You can lose employees. You can have all sorts of bad things happen. So I don't want to be sanguine about the idea that there are issues that, at least as a CIO, I can't make a strong connection between an issue and an investment implication. But when you have something called reputational risk, or you have these kinds of issues that become, highly polarizing, that can still have impact. So I think as an investor, we try to stay away from weighing in on those things as investors, even though we may have personal opinions or even firm-wide opinions about some of those things. And we often will have missives from our CEO on topics of the day that are important, but you can't invest against that.
Right, right. Well, one of the issues we hear a lot, and you've already mentioned the term, but is fiduciary duty. And what does fiduciary duty mean in different countries to people who've, who are fiduciaries? You've obviously been trained in fiduciary duty and not just know the rules, but feel that duty as a proper sense. And I often hear people say, oh, well, fiduciary duty is too narrow. We should be able to go beyond that or leave it aside. Can you talk a little bit about, what you feel that fiduciary duty really means and why it's so important as an investor to keep that fiduciary duty in mind?
Absolutely. So when I think about the role of a fiduciary, there are two primary concepts that to me are inviolable. And the first is that it's not my money, it's the client's money, right? So I am an actor on their behalf. And the second is that it has to have again, the word they often use is pecuniary, but you have to make choices that drive long-term financial best outcomes or best interests, right? Now, there's room to navigate within those two elements, right? So one question that you can ask is, over what time horizon, right? Because if you are looking at a longer term time horizon to achieve those financial outcomes, then other kinds of information might become very important, right? Because you have to have some bit of crystal ball into the future in terms of how that business strategy might evolve through time, what other things might be coming down the pike in terms of competition, regulatory environment, innovation. So I think that you can strike a balance while being a fiduciary, but also thinking about what other things might drive long-term value creation that aren't as evident in this very moment in time. And that's why I feel quite comfortable and confident in saying that ESG related issues can live hand in hand with a fiduciary mindset, because we often have evidence that we can demonstrate that these kinds of issues do have financial impacts for companies and thereby can drive long-term risk and reward. But again, it comes back to always first principles. Your primary mission is to deliver those kinds of results. And if you can, demonstrate that the activities that you're undertaking and the information that you're assimilating to help inform those judgments is going to be accretive in that way, then I feel you are expressing your fiduciary duty.
Yeah, I think that's a very clear way of putting it. And I always think about when people deviate from fiduciary duty, who are they serving instead? Is it themselves? Is it their own pet project or whatever it may be? Well, turning back to the markets, right now we're getting a little bit of a triple whammy of inflation, which most investors in the marketplace today have never really seen in their careers. The second is geopolitics and some tensions that obviously are worrying both from a humanitarian point of view, but also from an economic point of view. And then third, the market. The market has been very volatile. I think we have, now officially entered bear market territory. How do you think about navigating some of these issues, as a fiduciary with this long-term mindset? There's always this balance between don't overreact, but be aware. So tell us a little bit about how are you thinking about the environment right now, and what that means, first of all, is your role managing money for others, but then I'll also like to come back and hear a little bit about what you think it means for the asset management industry itself.
Yeah, it's certainly treacherous times out there, as you've articulated so well. And I guess my least favorite words in asset management are "it's different this time," because I've had the, I guess, dubious distinction of having lived through more than my fair share of market corrections and bear markets and such, and every time it's preceded by "it's different this time," and it ends up not being any different this time. So I guess that also gives me good heart, right? Because we will get through this. We obviously are encountering a very treacherous environment for investors. We've had double-digit losses in both equity and fixed income, which even I haven't experienced in my career on a calendar year basis. And again, we've got some calendar year left here to go, so perhaps that will change. But I come back to, again, kind of first principles. The first thing is, okay, are you a long-term investor or a short-term investor? And how do you think about your goals through that lens? Because if you really are a short-term investor and you were overexposed to speculative investments, well, that's very unfortunate, but that probably shouldn't have happened. But so what's your time horizon here? And for most investors, these are actually very attractive entry points, even while it may not feel that way in the moment. I think the second thing is that for many investors, this is kind of a gift, right? That interest rates that are 10-year treasuries over 3% is something that we have been longing for. I've got a lot of pension clients who have been dying to immunize their pension liabilities, that are getting great advantages to their funded status based on the backup in interest rates, and thereby higher discounting rates on those liabilities. And so they've got an opportunity to get their pension in a much better financial condition than it might have been when we had interest rates that are approaching zero. I think there's also this idea of, okay, how do you think about diversification in an environment where both stocks and bonds fall, again, in this case, double digits? Well, once again, we know how to deal with that, right? There are diversifiers out there. Things like gold, for example, are interesting diversifiers. Cash now has some yield, which it hasn't for a very, very long time. You can look at other kinds of exposures and real assets that benefit from inflationary pressures. So I think we've got the toolkit, right? And the question is just, how do you deploy it thoughtfully to achieve that outcome that you're trying to achieve? Now, that doesn't mean that you get a positive return, in an environment where the markets are being so difficult, but it does mean that it kind of grounds you back in what are the actions you can take, and how do you insulate yourself to the degree you can against some of these crosswinds. I think the other thing that we kind of come back to is, what are the things that are durable in terms of market moves? And one of the biggest ones is, what's the growth trajectory in the world, right? The geopolitical tensions are the flashpoints that get the headlines, but the things that ultimately drive long-term markets are the growth, right? And I think that's why we're seeing the kind of sell-off that we're seeing today and yesterday and the day before, is that there is this concern that the growth may be compromised if central bankers act too aggressively to choke off inflation. So there are landmines that are a bit, anomalous to this particular scenario, but I'd say as an investor, we will come out the other side. There's some interesting buying opportunities here, and lean into the tools that you have to diversify the portfolio and weather the storm.
Right. I think I always try to remember the Keynes quote of "markets can stay irrational longer than people can stay solvent." Like it's that matching, right? It's it's that matching of time frames that can get you through some of this. That's very interesting. And what do you think this means for the asset management industry? Obviously, since about 2009, the industry has a little bit had the wind in its back. There have been a few, bumps here and there, but it's been a dozen years or a little bit more than that since there's been a real hiccup. Do you think that we will see increasing consolidation in the industry, or is this one where you'll when the tide goes out, you'll see who's swimming naked, as the old saying goes? I mean, how do you see this going?
Well, again, I think there are some trends that are going to continue, right? So consolidation is clearly one, because this is an industry that is not growing top line organic growth the way it was a couple of decades ago. So by definition, when you get into an industry that's got slowing growth, one of the ways that you can win is by continuing to become more efficient and consolidating. So we think that that will continue. And what that always brings with it as well, though, is a spawning of smaller, companies that can compete in niche areas, alpha products, things of that nature. So I think that that's a durable trend, which also leads to the, how does this industry remain relevant? Because we've, investments have become so much more democratized, right? It used to be years ago, you worked for a company for your entire life, you had a defined benefit plan, all those assets were pooled and institutionalized. And now, most people have a 401k or they have their own journey of retirement. So you have to, so I think this industry plays an even more critical role in a lot of ways to advise those clients, those individuals, on how to navigate through storms like we're encountering right at this very time. So I actually have a lot of hope for our industry. I think there are other things, technology, the emergence of, perhaps new asset classes that get spawned by decentralized finance, blockchain. Like as a company, we're all in on understanding how those types of technologies can be embedded to strengthen our own business platforms, but also thinking about what it might mean in terms of innovation. I grew up in the 80s when, or I grew up in this industry in the 80s when securitization was just starting. So I think asset-backed securities, mortgage-backed securities, and I feel like we're on a wave of another type of innovative time frame like what we saw back then, which could be very exciting for the asset management industry. And then I guess the last thing I would say is that we have to remain relevant because I've got a couple of grown children who are much more do-it-yourselfers, one of whom tells me, Mom, you should never invest in equities, you should only invest in cryptos. So we have to, I think, as an industry, remain relevant around how we are helping investors save and navigate their financial freedoms.
So maybe the watchwords going forward, it sounds like our sustainability, really thinking about how the investment industry is supporting that, being a fiduciary, thinking about the beneficiary first, not something else, and focused on those long-term goals. I won't ask how the crypto account is going today, but to your point, right? If you've got a plan for your own retirement or your children's education or something that's 20 years out, you have a different mindset than if you're if it's play money and it's a casino, right?
Yeah, and I would say also smart innovation, right? So
right. Okay.
This whole democratizing of investments, it has a sort of a negative connotation in the sense that now people are kind of on their own, right? They've got to figure it out. There are obviously lots of resources in the industry, including a lot of very fine financial planners and registered investment advisors and such that can help them do that, or online tools or whatever. But then there's also that, and what else can we bring to bear, and how do we do that in a way? And the rise of the ETF, for example, was a great innovation in the sense that it makes niche asset classes that would otherwise be inaccessible to a private investor very accessible to them. Has lots of other benefits too, but that's just one example. So I think the other thing to add to your list of being a fiduciary and those other things is also smart innovation. Our industry can innovate. Think about retirement income product. As people move from accumulation to decumulation phase, there are things happening in our industry that will be very positive to serve society as well.
Okay. So last question for you. When you think about, pretend we're having this conversation in a decade or two out, it sounds like we'll have all sorts of innovations, some of which we've thought of, some of which we haven't. What else might you see differently in the asset management business if we get together, again, in a number of years?
Well, I probably should have commented on this way earlier in the podcast, but I'd like to see an industry that looks diverse and represents the broader population. So I happen to be a female in this industry in a position that very, very few females occupy, but we still have a long way to go on gender diversity. We also have a long way to go on persons of color, particularly underrepresented minorities. You think about any other group that you want to put into that mix. So that would be something else I'd like to see a decade out.
So more diverse, more innovative, more democratized, as you said, helping people get
more sustainable
and more sustainable. Okay, that is a nice vision for us. Okay, well, thank you so much for your insights and your leadership. I mean, as you said, there are very few people who are global CIOs of anything of the size that you are, and there are very, very few women who are. And so we really appreciate your leadership and this continued effort to be a fiduciary and to drive the investment management business to be sustainable and innovative. I think it's a great calling. So thank you.
Thank you.
Thanks for listening to today's episode of Going Long with FCLT Global. To learn more, visit our website at fcltglobal.org.